For the last 20 years, we've been told that automatically pouring our paychecks into the S&P 500 is the ultimate bulletproof financial cheat code. But what happens to a global economy when 90% of the money flowing into it completely stops asking what a company is actually worth? We need to talk about the great illusion of passive investing. If you are like most people, you have a retirement account, a 401k, or an investment app on your phone, and you are doing exactly what every financial advisor, podcast, and textbook has told you to do. You are buying index funds. You are buying a tiny slice of everything, sitting back and letting the magic of compounding do the heavy lifting. It is cheap, it is easy, and mathematically, it has beaten the supposed smart money on Wall Street for decades. You are told it is the safest place for your money. But there is a mechanical flaw in this system that nobody wants to talk about. The very vehicle that democratized wealth for the middle class has quietly mutated into the largest, most concentrated systemic risk in modern financial history. We have built a multi-trillion-dollar house of cards on auto deposit, and the foundation is starting to wart. To understand why index funds are a brilliant trap, we have to strip away the Wall Street jargon and look at the actual plumbing of the stock market. At its core, a stock market only has one real job: price discovery. Imagine a massive farmer's market. You have buyers and you have sellers. The buyers want to pay as little as possible. The sellers want to charge as much as possible. Through the messy, chaotic process of haggling, analyzing the quality of the apples, and looking at the weather forecast, they arrive at a fair price. That is price discovery. In the financial world, this haggling is done by active investors. They read balance sheets, they analyze earnings calls, they look at supply chains, and they argue over whether a company is overvalued or undervalued. But passive investors, which is what you are when you buy an index fund, do not haggle. When your paycheck hits your index fund on the 15th of the month, that fund does not look at the price of a stock. It does not care if the company just invented a cure for a disease or if their CEO just embezzled millions and set the factory on fire. It is blind. It simply walks into the market and buys every single stock in the index at whatever price the active investors have negotiated. That system works perfectly fine, as long as the blind buyers are a minority. As long as there are enough active buyers doing the research, the prices remain somewhat tethered to reality. But that is not the world we live in anymore. Over the last 15 years, we have witnessed a massive, unprecedented migration of capital. Trillions of dollars have been pulled out of active management and dumped into passive index funds. Today, passive funds dictate the vast majority of daily market flows. So, what happens when the blindfolded shoppers take over the entire market? The haggling stops. This brings us to the first mechanism of the trap: the concentration loop. Most popular index funds are what we call market cap weighted. That means the bigger a company is, the larger the percentage it takes up in the index. When you put $100 into an S&P 500 fund, you aren't putting 20 cents into 500 different companies. You are putting a massive chunk of that money directly into the top 5 or 6 tech giants, and microscopic fractions of a penny into the companies at the bottom. Here is where the math turns toxic. Because the massive companies take up so much of the index, every time everyday workers blindly invest their paychecks, those big companies get a disproportionate mountain of automatic cash. What does that cash do? It pushes their stock price up. And what happens when their stock price goes up? Their market cap grows. And what happens when their market cap grows? They take up an even larger percentage of the index, which means next month, when your paycheck clears, an even bigger slice of your money is forced into those exact same companies. It is a blind, mechanical feedback loop. The biggest companies are no longer growing simply because they are innovating, or selling more products, or generating better margins. They are growing because they are acting as gravitational black holes, automatically sucking in the world's passive capital simply because they were already big to begin with. You are told that buying an index fund means you are beautifully diversified across the entire American economy. But right now, a handful of mega corporations dictate nearly the entire direction of the index. If those few companies stumble, your diversified portfolio drops like a stone. We have replaced the risk of picking individual stocks with the illusion of safety, completely ignoring that the index itself has become dangerously top-heavy. But the concentration loop is just the symptom. The actual trap, the part that should make you sweat, is the liquidity illusion. Liquidity is just a fancy word for your ability to sell your shares and get your cash out without crashing the price. For your entire investing life, you've assumed that if you hit the sell button on your brokerage app, there will instantly be someone on the other side of the screen ready to buy it from you at the current price. Passive investing operates on the assumption that there will always be an active buyer to take the other side of the trade. But remember the migration of capital? We have spent a decade starving active managers of cash. The haggler at the farmer's market has virtually no money left. So what happens when the macro environment shifts? What happens when inflation spikes, or a geopolitical crisis hits, or the unemployment rate suddenly jumps, and the algorithmic models tell the massive institutional funds to reduce risk? They hit sell. But because the market is dominated by passive, automatic systems, they don't sell individual bad companies. They sell the entire index at once. The passive funds become forced sellers. Millions of shares of 500 different companies are dumped onto the market simultaneously. Normally, this is where active investors would step in. They would look at the crash, identify the good companies that are being unfairly dragged down, and buy them at a discount, stopping the bleeding. But there's one problem. The active buyers don't have enough capital to catch a falling knife of this magnitude. The exit door for the market has remained the exact same size, but the amount of money trying to blindly rush through it in a panic has grown exponentially. And that's where the real danger begins. When the passive selling triggers more price drops, it triggers more algorithmic selling, which triggers even more selling, creating a downward spiral that is entirely disconnected from the actual financial health of the companies involved. This is the vulnerability. We have engineered a market that goes up mechanically on autopilot, which feels great. But that means it will also go down mechanically on autopilot, with no circuit breakers of human reasoning to catch it. You aren't participating in a rational market of price discovery anymore. You are participating in a giant momentum-driven algorithm fueled by automatic paycheck deductions. This isn't to say you should pull all your money out tomorrow and hide it under a mattress. It doesn't mean the market goes to zero. But it does mean you need to wake up from the fantasy that passive investing has eliminated risk. It hasn't eliminated risk. It has just delayed it, accumulated it, and hidden it in the structural plumbing of the market itself. Volatility is going to get weirder. The drops will be faster, sharper, and more illogical than anything we've seen in the textbooks. Your wealth is tied to a system that has stopped asking what things are worth, and eventually, reality always demands an audit. Make sure you understand the mechanics of the game you are playing, because the autopilot is only comforting until the engine stalls. If this breakdown helped you see the market a little more clearly, hit the subscribe button. We're going to keep peeling back the layers of this system together.